Real estate investment presentation, adjustable rate mortgage or ARM. Get ready because we're raising the stakes with real estate. We're adding a bit more detail to the adjustable rate mortgage or ARM, noting that working practice problems is the best way to really understand some of these concepts. We do work many different practice problems. Also realize that being able to compare any deviation to, say, the norm, in other words, the adjustable rate mortgage is something less common than the standard mortgage, which in this case would be the 30-year fixed type mortgage. It's best to have that baseline in your mind, the 30-year fixed in your mind, and then think about what the differences would be as we think about the variations of loans, this being the adjustable rate mortgage or ARM. Also note that we are looking at terminology here, so we're going to be referencing Investopedia, which is a place you can go to look up investment terms and further your research from there. So the adjustable rate mortgage or ARM is a type of mortgage where the interest rate applied on the outstanding balance varies through the life of the loan. So how that variation takes place, we can have different structures the way that that's going to work, but that's going to be the general concepts. Why would that be the case? Well, if you have the borrower typically is going to be wanting a lower interest rate, lower payments. How can we get that in terms of the lender? How could that be beneficial to the lender? One way would be to transfer the risk from the lender to the borrower, risk related to future increases, say, in inflation and market interest rates. And they can do that by having an adjustable rate, allowing them to give that initial rate that's going to be lower than it otherwise could. So that's the basic trade-off that is taking place with the adjustable rate mortgage. So more risk then to the borrower. The borrower then has to be more careful in terms of the risk scenarios that would happen in the future, and the lender does not, because now they're more secure about those, and therefore the lender is generally able to give a lower rate up front, lower payment up front. So the initial interest rate is fixed for a period of time. After that, the interest rate resets periodically at yearly or even monthly intervals. So every year is quite common, possibly though even every month it could adjust. ARMs are also called variable rate mortgages or floating mortgages. So if you hear the term adjustable rate mortgage or the term ARM or the term variable rate mortgage, which would of course also indicate that variation, or floating mortgages, we're talking about the same kind of thing here. The interest rate or ARMs is reset based on benchmark or index plus an initial spread called an ARM margin. So you might think, well, how does this actually functionally work? Meaning, how are they going to adjust the rates into the future? Do they just kind of guess and adjust the rates? No, there should be an index. The index is not going to be determined by the lender. It's determined outside the lender and should be a reflection of what is happening in the market. The adjustment on the rates then is going to be tied to the index, meaning the baseline will typically be the index plus some margin, that being the ARM margin. Then on top of that, you might then apply some other restrictions, for example, caps that we'll talk about later, which could include rate caps or payment caps. So continuing on, an ARM is often expressed as two numbers. In most cases, the first number indicates the length of time the fixed rate is applied to the loan. For example, a 2/28 ARM features a fixed rate for 2 years followed by a floating rate for the remaining 28 years. So if you see 2/28, you would think fixed rate for 2 years, and if it's a 30-year loan, 30 minus 2 would be the 28 years remaining. You got the adjustable rate for that 28 years. A 5/1 ARM has a fixed rate for the first 5 years, followed by a variable rate that adjusts every year. A 5/5 ARM would start with a fixed rate for 5 years and then adjust every 5 years. So you can see how you can apply different kind of combinations of when the fixed portion and when the variable portion would apply. This can get a little bit confusing, of course, when you're trying to compare different loans. Note that if you just had basically an adjustable rate, basically that was like for 1 year, for example, of a fixed rate, and then it became adjustable every year after that first year, which would be like, you know, the most pure kind of adjustable rate you have, and you're just going to adjust it every year, then you'd be putting a lot more of the risk from the lender to the borrower, which would probably mean that the lender could lower that initial rate and result in lower payment for that initial amount. Further, most likely, the more you extend the fixed portion, meaning if you say have the fixed portion going out 5 years as opposed to 1 year out or 2 years out, Now you've taken some of that risk that you had shifted to the borrower, and you're shifting it back to the lender a little bit, right? So you would assume then that the lender might have to have a little bit higher rate because they're taking out a little bit more rate than if you basically had a completely variable rate loan. So you've got this interplay between the risk going between the borrower and the lender, and then trying to hedge back that risk by possibly having a longer period of time. And later we'll talk about hedging back that risk with caps, rate caps or payment caps. And this kind of interplays as you hedge back could result in the lender then offering a different initial rates up front. So it can be kind of confusing when you compare these different scenarios out. So indexes versus margins. At the end of the initial fixed rate period, ARM interest rates will become a variable or adjustable. They will fluctuate based on some reference interest rate, the ARM index, plus a set amount of interest above that interest rate, the ARM margin. So we've talked about that's basically how it's going to work in the future, how the adjustment will actually be calculated based on an index plus some margin called the ARM margin. The ARM index is usually a benchmark rate such as the prime rate, the rate on short-term U.S. Treasury, or the Fed funds rate. So these are common kind of starting point or base point rates on which the margin, the increase over the rate, would then be applied. The margin stays the same. For example, if the index is 5% and the margin is 2%, the interest rate on the mortgage adjusts to 7%. That's going to be a general idea. So if these indexes go up, then you're going to increase yours just 2%, in this case the margin being 2% above that amount to 7%. Now again, you could see this scenario, we can apply an added complication if we so chose by applying rate caps or payment caps, which we'll talk about in a second. However, if the index is at only 2%, the next time the interest rate adjusts, the rate falls to 4% based on the loan's 2%. So if the index was at 5% and then it went down to 2%, 2%, if the index is only at 2%, it would be at 4%, the loan's margin being 2%. So right, the index could go down and you're still going to be 2% from the margin. So the idea here being is that the index, when you hear this adjustable rate, it's usually thought of as a bad thing, and it kind of is with regard to risk, because you're taking on risk as the borrower. But it could end up beneficial because the index, it's possible that the index basically goes down. It depends on whether you're on an inflationary period or the rates going up or the rates going down. The point is that you don't really know what that is up front. That's point number one. And point number two is at least inflation will typically be going up over time, which tends to increase rates over time. So you would think over a long period of time, the loan being 30 years, and if you were to have the loan for 30 years, that there would be, generally an increase in the rates over that time frame. At least if you're starting out with basically a fairly low rate at the starting point. So in any case, next item, ARM versus the fixed rate mortgage. So if we compare and contrast the two, remember the fixed rate, that's kind of our standard, and even more standard would probably be the 30-year, fixed rate type of mortgage. So the traditional or fixed rate mortgage carries the same interest rate for the life of the loan. That's obviously the point here. We got the same rate for the life of the loan. You locked it in. Therefore, as the borrower, you have a lot less risk. The lender has a lot more risk because if you're paying them money like 30 years into the future and you're paying them the same payment and you went through an inflationary period, then you're paying them back with money that's worth a lot less than it was up front. So notice that the lender's taking on the risk. That's going to be, so they generally have higher interest rates at the outset than ARMs, which can make ARMs more attractive and affordable in the short term. So clearly that's the point of the ARM. So the borrower's going to say, hey, is there any way I can get this rate to be lower and my payments lower? That would be great. And one way to do that is to transfer the risk from the lender to the borrower, allowing at least that front portion of the loan to be lower. The later portions are dependent then on what's going to be the fluctuations in the market. So fixed rate loans provide the assurance that the borrower's rate will never shoot up. So the idea of the fixed rate is that it's fixed and you can make the payment because you know what the payment is and you've budgeted that in, and you're not going to have this huge increase even if there's some giant inflationary time period that happens because of some craziness going on in the market or whatever. So with a fixed rate mortgage, monthly payments remain the same, although the amounts that go to pay interest or principal will change over time. So we've seen the amortization tables, and you really want to get an idea of the amortization tables on your 30-year fixed mortgage and see how the breakout of the interest and the principal kind of work out, even though the payments are the same, to end up in a fully amortized loan at the end, meaning the loan balance is zero at the end point. So if interest rates change in general fall, homeowners with fixed rate mortgages can refinance, paying off their old loan with one at a new lower rate. So it's another benefit kind of the fixed loan. You can refinance possibly the adjustable rate, but the fixed rate, if you have the fixed rate, you kind of have the best of both worlds in terms of risk, because if inflation goes up, then you're looking pretty good, because now you're paying back your loan with inflated dollars, and that would generally be beneficial. That's why you locked in the rate. And if the rate goes down, then you might be able to refinance the loan. Could cost a bit to refinance, but you can possibly refinance and still get access to those lower rates. So whether the market goes up or down, you might be able to negotiate or work out a favorable position on the 30-year just in general, whereas you have a little bit more risk in terms of the adjustable rates, more exposure to that rate increasing or decreasing generally. So is an adjustable rate mortgage right for you? Possibly, if you are planning to keep the loan for a limited period of time and you will be able to handle any rate increases in the meantime. So obviously there's pros and cons. Note that these kind of loans have kind of gotten a bad name ever since there's the decrease in I believe 2008, which was a home downturn in terms of real estate market, which has a whole lot of different factors that were involved in it, including regulatory factors and best practices and trading different securities, mortgage-backed and so on. So there's a whole lot of other things that go in there. The key point here that I'd like to basically point out, though, is that these different variations on the mortgages are not bad in and of themselves. They have pros and cons, and you could see the trade-off pretty clearly within them, that being that the lender is going to be reducing their risk, the borrower taking on more risk in exchange for those lower rates up front. The problem with them is they can be more complex, and it can be a little bit more difficult to communicate properly within them. So you want to make sure that you're in a negotiation where the two parties involved in the negotiation know exactly what's happening in the negotiation, so that they can both be acting in their best interest, which gets a little bit more difficult when you're talking about loans that are just more complex in terms of their nature and their structure. So if you're in an environment where basically the regulations are softer, or if you're saying that the banks for whatever reason have some kinds of incentives to take on loans which even they do not think are the most secure types of loans, possibly because they'd be selling the loans on the secondary market, those kinds of things could lead these type of tools to be misused by basically not having full communication on both sides. But if both sides know what the trade-offs and benefits are, and then they could be good tools in certain circumstances. Some of those circumstances possibly being if you're planning on holding the loan for basically a shorter period of time and still taking into consideration kind of worst case scenarios, what would happen? Would you still be okay if things went poorly? So in terms of the markets, meaning interest rates shoot up for whatever reason. So in many cases, ARMs come with rate caps that limit how much the rate can rise at any given time or in total. So note, you can put the caps back on there as well. So we talked about the rates being increased with regards to the margin. But again, remember there's pros and cons between these types of things. So if you were to say you want an adjustable rate mortgage, you're shifting then the risk from the lender to the borrower, and you possibly could result in a lower rate. If you then say, but I want to put rate caps on it so that even if there was an increase in the rates or in the market in the future, my rate doesn't go up that much, right? Even if the market went up really high, I have a cap, or I have a lifetime cap, so the rate cannot go up above a certain amount. Well, now that's good. That could be a very good thing. But now, of course, you've hedged some of the risk that went from the lender to the borrower back to the lender. And so that might mean that you might not get as favorable a rates because it's a trade-off between the risk assessment and the rates that are going to be gotten. You can also get payment caps, which work a little bit differently. That you cap the amount of payment instead of the rate. They sound a little bit more confusing. We'll actually work a practice problem so you can understand those. But the basic idea is, again, the caps kind of hedge off some of the risk from the borrower back to the lender. So periodic rate caps limit how much the interest rate can change from one year to the next. Lifetime rate caps set limits on how much the interest rate can increase over the life of the loan.